Hello folks, this video I'm going to talk about how you can anticipate price movements based on the economic calendar. Okay, this right here is the E-mini Nasdaq March delivery futures contract. And okay, so I bet that 95% of the people watching this video uh, have probably heard or think that news trading is gambling. A lot of you, right? And well, you know of some guy, always everybody knows of some guy or some YouTuber or somebody that can tell you it's gonna go up or down. Okay? But what if I tell you I can tell you if it's gonna go up or down, but by how much? How about that? How many times have you heard that, How many times have you heard someone say, I can tell you where the news is gonna draw to by exactly how much? Well, you can do that by just using your chart. You don't even need anything, alright? So you can do this for any kind of news event. Uh, red folder, obviously, red folder only. And so leave you. I'm gonna let you do the back testing on all the different kinds of news. But this is a really good time to show how powerful opening range gaps can be. Okay, if you haven't watched my last video, it was about opening range gaps and how you can use them in your own trading. And I think a lot of people think that opening range gaps, they're just another concept. They're not that powerful. Sometimes they get traded back into, sometimes they don't. They're not really that strong of a draw of in liquidity. Okay. So, what is the biggest, baddest news, Trevor? It's the federal funds rate. All right, or the Fed interest rate. It is more commonly known as that. Okay. So, all right. So, look at my chart. Try and guess which candle shows the Fed movement, Fed interest rate movement. I'm gonna give you a hint. It's the biggest candle on the chart, right here. Okay, that right there at 2 p.m. The Fed released the interest rates. Okay, and as you can see, the market dropped down 1,000 points. Okay, what if I tell you? I can tell you exactly. I could have told you right here exactly by how much it's gonna drop down to. That sounds interesting, right? Okay, so let's switch to regular trading hours and check for opening range gaps. Okay, so let's say you're right there. So you have this opening range gap, but it gets traded to at least consequent encroachment. We can check that right there, and then there. See that the price trades above the white line. All right, let's check this gap right there. Price does not trade back into the midpoint, so that's an open gap according to my I don't know, my analysis, my criteria. Okay, this gap is also not closed. So what's happening here? This gap is closed though. See that? See how the algorithm draws to the midpoint and leaves? It hits that, boom, goes away. But notice how this is unfilled and that gap is unfilled, and there's this gap also right here. Let's just highlight that. Okay, so let's say you were right here. Okay, and you see these gaps, they're unfilled. And go back to my last video. I told you that every gap that's unfilled is a draw on liquidity until it has been traded to at least consequent encroachment. All right. So when you're right here, this could have been a draw on liquidity for you, okay, or this, because these are both open gaps. And FOMC with the interest rates is a real bad news. I'm sorry, a real big news event. All right. So you could have targeted that. You could have targeted that. Or you could have targeted the only, not the only, the oldest opening range gap in the entirety of 2024, right there. Now, what are the three levels that I told you were important and the algorithm refers to? The low, the high, and the consequent encroachment right there. Look at that. Look at where price trades to. Don't worry about this candle. That candle, that's the next day. That's Thursday. This is Wednesday right here. FOMC day. Where does it trade to? Exactly there. And there's no other gaps below this. There's no other gaps that have, been not traded to at least the midpoint. Okay. So this is just one of the examples using one singular smart money concept, showing you how you can predict by how much a news event is going to move. Okay. You can do this for every single news event there is. It should cause volatility, obviously. It can't just, do nothing, then, you have nothing. But that's my point, right? And I'm going to let you do the homework and the hard work of, going outside and, trying to backtest news events and see if you can predict where they're going to go. I just showed you how to predict the biggest, baddest news event that, occurs only 8 times a year. Right there. It's in front of you, folks. If you knew it right there and traded one singular micro, you know how much money that is? That is $10,000. And how much risk is that? That's like, I don't know, $200 of risk. Not 200. I'd say, yeah, 200 is a fair amount. Okay. So $200 in risk and $10,000 using one single micro contract. If you just knew this, if you just, didn't blindly believe that, news is untradeable and it's all random and actually went to the charts. All right. So I'm not going to rob you of the learning opportunity. And actually, I'm actually going to let you go into the charts and, look at the other news events that happen. Like for this, let's look at this week, right? Let's go back to ETH. This week, every single news event that was bearish went down by a lot. That's a news event, and that's a news event right there. This, I don't think that's a news event, but there was one news event, I think here or here, that you see how price went up. It was bullish, but not by much. See that? When it was bearish, it went down like that. When it was bearish, it went like that. It went down like that. You see the algorithm. It can't control the nature of the news because that's beyond it, but it can definitely, most definitely control by how much is it going to move, by how much is it going to let the price go the way it wants. Why did it let the price drop all the way there? Well, it helps in two things. First off, it fills all these opening range gaps. Okay. And secondly, you see all these lows here? See that? Notice how any of these lows don't sweep the previous low, at least here. See that? So what is that doing? Every time a retail trader sees a low formed and price trades above that, what's happening here? What's collecting here? Sell stops. People are going long here, 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 here. Where are their sell stops? Right there, right there, right there. Okay. People who are long right here, when they're here, where did their stops trail to? Right there. When they're here now, where did their stop losses go? Right there. Okay. So these are very obvious draws on liquidity, and the algorithm engineered these lows right there. The algorithm knew that, we're having a big news event incoming in a few weeks. And it did this. This is all algorithmic, folks. You cannot convince me that, this is buying and selling pressure because 1,000 points dropped. And, so you're telling me that, people were like, oh, let's sell through all of this. And then right here, for some reason, oh, you know what? Let's buy now. Let's go up. Let's not keep going down. It's just fairy tales, folks. If you believe it's buying and selling pressure, I am Warren Buffett. Like it's that stupid, you know. Anyways, obviously I highlighted that's my drawn liquidity for the next week. We're gonna go up, create a Judas high, and go down, sweep that. Anyways, that is how you can try and predict exactly where news events can cause price to go to, manipulate to. All right, that is it for this video. Thank you for watching.